Hi everyone. So a key macroeconomic policy tool used by governments around the world is that of monetary policy. Now, monetary policy fundamentally involves changing the available money supply within an economy, usually by using interest rates to do that. Interest rates themselves represent the cost of borrowing and the reward for saving. Okay, let's take a look. So, as we've said, it involves using interest rates and other policy options to influence the money supply within an economy. What is the money supply? Well, it's the total amount of money circulating in an economy at any given point. Okay, and this is going to consist of two main areas that you need to be aware of, and that is firstly narrow money, i.e. notes, coins, bank deposits. These are the most liquid assets, so these are assets readily convertible into goods and services. So you can use these assets to go and buy goods and services. When it comes to broad money, well, this is about a far broader definition of money, and it includes more illiquid assets. So it's about the total amount held by households and firms. So to that extent, it would involve government bonds as well as shares and other illiquid financial assets that are actually held, which could be locked away savings accounts and so on. Okay, so that broad money encapsulates all of the money circulating around an economy. Right, now we mentioned these other policy options within our definition for monetary policy. So what are they? Well, firstly, quantitative easing. So quantitative easing has been undertaken by the Bank of England since the financial crisis and the credit crunch in 2008. And this was attempted to really provide liquidity to the UK economy. So that is to boost the available money supply that was circulating around the economy. So not only were interest rates dramatically reduced to just 0.5%, but quantitative easing was undertaken to the tune of £375 billion being created. There was further quantitative easing undertaken after the Brexit referendum as well. Okay, and what is quantitative easing? Well, it's about the creation of currency. This currency is then distributed to financial services companies in return for UK government bonds. So it's by this very method that the Bank of England itself has actually acquired a huge holding of UK government debt by actually creating that currency and providing that to those financial service companies. The objective then, of course, is that those financial services companies, such as banks, will then have more liquidity, that is available money to lend to the real economy. And because they have this additional money, they don't want it, in theory, just sat in their bank account. So they want to go and lend it, so they will lend it at relatively low interest rates. So it has much the same impact as a reduction in interest rates. Okay, it increases the available money supply in an economy. Then we've got this notion of forward guidance, which has really been something that's been talked about under the governorship of Mark Carney, the Bank of England, and it's about these verbal assurances about the intended direction of monetary policy for the UK economy. But this has been a policy option which has been much criticised, because while he said one thing, it's actually meant that economic circumstances have changed in 6 months' time, and therefore he hasn't actually been able to go ahead with those intended plans from that prior period because of extenuating economic circumstances. So anyway, that is used, and that is meant to reassure businesses and consumers about the future of the UK economy and the direction to which interest rates are likely to go. Okay, so it's really about trying to encourage people to borrow sensibly and the economy to take sensible decisions with that in mind. And then there's also the reserve requirement ratio. And the reserve requirement ratio is a regulation set by a country's central bank that determines the minimum amount of reserves that banks must hold. So perhaps you could have a reserve requirement ratio of 20%. That would mean for every £100 that is lent, you must have £20 available in the bank's liquid assets. Okay, if of course the Bank of England were to reduce that reserve requirement ratio and cut it to 15%, then for every £100 that is lent, they only need £15 in liquid assets. So that would mean that the available money supply in the economy would increase. Okay. All right. So overall, what are these aims of monetary policy? Well, the number one aim when it comes to monetary policy and the work of the Bank of England and its Monetary Policy Committee is about price stability and targeting a consumer price index of 2%. Plus or minus 1%. Okay, so they are given some leeway there, and should they not manage to actually uphold that plus or minus 1%, then they need to write a letter to the Chancellor of the Exchequer. So the Governor of the Bank of England will write that letter, and really that is just highlighting the responsibility that is given to the Bank of England to ensure that they are working towards that medium term aim of achieving 2% level of CPI inflation. But this is something that's again much criticised because of particularly the Bank of England's failure to achieve that 2% level of CPI inflation over the medium term. Okay, and then finally there's the notion of economic growth as well, of course. So when it comes to economic growth, the Bank of England obviously keeps a little eye on economic growth there as well and makes sure that their policies are consistent with future economic growth. Okay, thanks guys.